Hi, last Sunday I sat down and read the weekend papers and I learned that the local property markets had fallen 15%. Now this type of sensational headline, which suggests that the Melbourne property market is in free fall, is clearly incorrect. But obviously it scared many investors and homeowners. On the other hand, I know some people are thinking, isn't it great? I can now buy a property maybe $75,000 cheaper than I could last year. But then I read on and I found that while the Australian Bureau of Statistics reported that the Australian median house price fell 2.2% in the March quarter and were 6.7% down in the year to March 2009, Residex reported a smaller fall, maybe about 0.8% of house prices in the March quarter, and RP Data reported a 1.5% rise, not a fall, in the March quarter. I kept reading, and at the same time as these other reports, the Reserve Bank outlook for houses is relatively upbeat, despite the threats of weakening economy and rising unemployment. The Reserve Bank said as follows: looking ahead, low mortgage interest rates and the increase in grants for the first home buyers have made home purchases more affordable, and this is expected to support residential building construction. Now this view was also supported by what the Reserve Bank called positive signs in forward-looking indicators. So I did some more reading, and when I looked at the Real Estate Institute of Victorian statistics, I found that over the last week there were about 1,000 private sales. And you'd have to go back way back to March 2008 to see that many sales in just 1 week. Even the total turnover of over $570 million is reminiscent of the heady days of the Melbourne property market in 2007. So what's going on? Are our property values falling, or aren't they? Too often what's reported about house prices is wrong. Firstly, there's always a discrepancy between what the Australian Bureau of Statistics reports and what other research houses report. What the media doesn't clearly report is that the most recent ABS quarterly figures are preliminary estimates and they're going to be revised later. And these nearly always seem to be revised upwards. You see, a considerable part of the inconsistency reflects the impact of what I'd call early sample bias in the Bureau of Statistics data. The preliminary figures that they report on are based on information just from the banks, and when the Bureau of Statistics uses much more comprehensive data collated from the title office, the figures are likely to be revised upwards. Also, the Bureau of Statistics index excludes all the apartments, semis, terraces, and only examines freestanding houses that could bias the sample towards the more expensive end of the market. And as we know, there's currently a wide divergence in house price movements. Prices in the more expensive suburbs have fallen significantly over the past year. At the other end of the market, prices for houses and apartments in the lower end suburbs have been supported by first homeowner buying. Now, another reason lower median house prices are showing up is that there were more lower priced properties sold than in the months before. Statistics show that a larger proportion of the property transactions that are currently occurring are occurring under about $500,000, more than there were last year, and hence the median prices have fallen. Now, while this is mainly due to the first homeowners grant, I've also noticed another interesting trend. Many investors are taking the opportunity currently to clean up their portfolios, and they tend to sell their lesser quality properties and they hang on to their prized properties. This influx of secondary properties on the market reflects in the poorer sale prices. Now, I know that our team of buyers agents at Metropole keep mentioning that while there are lots and lots of properties on the market, there are very, very few that we'd consider buying for investors. Most just don't pass our stringent investment criteria. But many of these properties are being currently snapped up by emotionally charged first home buyers. There's no doubt that the overall property markets are flat, but we're tending to see 3 markets in Melbourne and the same 3 segmentations in Sydney and Brisbane. Currently, properties under around $500,000 or so are selling very strongly, driven in particular by first home buyers. When you find a quality property in this price bracket, you're likely to come up against some pretty stiff competition for it. But don't let that deter you. Do your due diligence carefully, work out what the right amount to pay is, and then if you want it, secure the property before someone else does. On the other hand, if you can afford a property between $500,000 and say $900,000, you're likely to be able to snare a bargain. There's much less competition in this price bracket, and properties in this price bracket are on special, I guess we could say. They're often much cheaper than they were last year. And then we found properties above $1 million or so. In that market, it's very subdued. This is not where we tend to look for investment properties though anyway, is it? The flat property markets are not surprising considering the global and our domestic economic situation. And I expect continued sluggishness in property price growth over the next year or so. But I don't expect significant falls as the effects of lower interest rate and the increased affordability work their way into our markets. What that means is that there are some great opportunities for property investors to get set for the next property cycle. But you just can't buy any property. In changing times like we're currently experiencing, no one can help you quite like the independent property strategists at Metropole. By the way, we help homeowners too, not just property investors. Now, please remember we've got no properties for sale, but we do have access to every property on the market. So if you want to find out a bit more about what's happening in your local market and what our research suggests is in store for you, join us at one of our free property briefings in our boardrooms in Melbourne, Sydney or Brisbane. Just click on the link below to find out more and reserve your place. So to sum up this market update session, I'd like to explain that I've got really strong positive views on the property markets in most of our capital cities in the medium to long term. I'm certainly aware of the potential short-term problems related to the credit crisis, poor market sentiment, and what that means is you should be looking at the right property, at the right price, in the right location, getting the right sort of rental income. In particular, properties to which you can add value, bought below intrinsic value. If you want to find out a bit more about what's happening in your local market and what our research is suggesting is in store, again, please join us at one of our free property briefings in Melbourne, Sydney or Brisbane. We run them in our boardrooms. Just click on the link below and reserve your place. Also, if you'd like to thrive in these changing times, while others are having difficulty just surviving, then I'd like you to check out my new book, which is destined to become another top seller. Thank you for all of the readers who've already bought this, but if you haven't, read about my book, Thriving, Not Just Surviving in Changing Times. Click on the link below so you can find out more about it. Thanks for watching my property market update.